Good afternoon, everybody. Welcome to the TraderMerlin Show. It's your Monday, the final Monday of March of 2023. The final week. We actually have a full trading week, which will end on Friday, wrapping up our March. And of course, I'll be running through all the numbers at the end of the week to see how we fared for the month. It's definitely been a very volatile one for just about every asset class out there. So there we go. I know Sam Evans went to the, Sam Evans went to the dark side. He went to work for the saddest place on earth. Anyway, no, not Disneyland. Yeah, well, maybe. I don't want to talk about that guy anyway. Hopefully Sam will come to his senses and come back to reality, and then we'll bring him back on the show to talk markets. Anyway, let's go to the topic du jour. I am, of course, going to go into the top 7 markets here and go over a little bit of what happened in our broader markets, but the question came in, and I thought, you know what, you guys always steer the conversation. So I asked Chat Midjourney to create me a picture of Mickey Mouse looking beaten up and just having a rough day, and there you go. Disney, saddest place on earth. Now, of course, I should have put an exclamation point on this one, making it a statement or a question, right? Is this really the saddest place on earth? And this was all started because of this question here from Irfan. He says, thoughts on Disney? I heard they're doing massive layoffs. All right, so this was obviously one of the bigger talk tracks for today's trading session, but when you peel back the onion, you realize that this is, I gotta say, almost a non-event. I know the 7,000 people that are getting laid off from Disney can be like, well, I can't call it a non-event. I'm losing my job. We talked about this over the past couple months and how a lot of companies right now have employment bloat, right? During this kind of bull market phase, it started with the $15 to $20 trillion, depending on which metric you look at. That $15 to $20 trillion that was pumped in by the Fed and our elected officials, that created a hiring frenzy. And all of a sudden, a lot of companies, including a lot of the tech ones, which have been going through massive layoffs, have started to do some tech bloat or employment bloat, bring on a lot of people and ultimately, struggling quite a bit now, maybe with all this extra overhead. Margaret says, is that picture legal? Good question. It's an artistic rendering of a mouse that's actually different. If you notice the picture there, I believe that the Mickey Mouse only has 2 dots on his stomach right here. This guy's got 3. The eyes are different. He's got 4 fingers as opposed. So I think that this is different. It's an interpretation of it. Anyway, I think when you look at the numbers, you realize, okay, well, Disney is laying off 7,000 people. But let me ask you, for the viewers out there, when you hear the number 7,000, you instinctively think, oh crap, this is really bad for Disney, right? They're just slashing a lot of jobs. But would it make a difference to you if they had 14,000 employees versus, let's say, 200,000 employees, right? 7,000 of 14 would be 50% of their, is it almost up? Well, that would be if I drew the exact picture, Talking Monkey. I think that this is different enough with colors and, well, anyway, they can give me a cease and desist. I'll be happy to take it down and put a different picture up there. So if you lost 7,000 of your employees and you only had 14 to begin with, okay, I'd say that is drastic. You're losing 50% of the workforce. What percentage of the workforce is 7,000 jobs for Disney? Just curious if you guys know that off the top of your head and maybe been circling around in some of the publications. If you look at the total number of employed at Disney, it's right around 220,000 people. There's 75,000 people employed just at Disney World alone in Florida. So, you lose, let's say you lost 7,000 jobs at Disney World. Okay, that's 10% there. But out of 220,000 jobs, it's only about 3.8%, maybe 3, let's call it 3%. I'll call it 3%. So it's really not that big of a deal overall. I would actually say that this, and this sounds horrible, but this is probably good for Disney because as you look at your spectrum of 220,000 employees, you're probably going, okay, Kevin, you really bring no value to the table. You're out. We thought we needed you when we were growing a lot. Now we're slowing down a little, so we'll get rid of you. And you start to pick apart some of those people that don't really carry their weight. When you start to go and downsize your company, obviously the ones that bring the most value to the table, whether that's intellectual property or actual production value, you're going to keep those ones. The ones that don't, you get rid of them, and you find maybe there's divisions that were cut. Maybe there were films that were just scrapped that Disney was lining up. Maybe there was new centers being built or expansions. So 7,000 jobs to me is really not that big of a deal, Irfan. I'm actually kind of going no big deal. And Oliver says Disney doing layoffs again. This is actually old news anyway, because if we look at the Disney chart here, This is almost a case of buy the rumor, sell the news, in my opinion. You look at the news today, which was all about this Monday morning. You can see we gapped up today, gapped up just so slightly on Disney, and actually rallied 1.64% on Disney today. So a lot of people going, okay, this is the news today. No, the news was dropped back here in February. So you can see Disney jumped up on February 9th when Bob Iger initially made the statement that said, hey, we're going to start doing some layoffs here. Now they're actually implementing those. Those layoffs are going to start to happen this week. So essentially what you had was almost 2 months where Disney told their employees, hey, look, we're going to be making some layoffs. We just don't know who. This week is now we know who. So it took them 2 months to figure out who to get rid of at Disney, and now that's going to start hitting this week. So on surface value, I look at this and go, not only is this, in my opinion, really a non-event for the shareholders, I think it may actually be good for the shareholders in the long run because you're getting rid of some overhead that maybe should have gotten rid of a while back. If we look at the earnings, and you guys know I am not a fundamentals person, so don't shoot the messenger or go off on me, but $1.83 per share. You've got a relatively high PE ratio of 52 on this one. But you look down here, their earnings, yep, talking monkey, I'd agree. 7,000 employees is cost savings. Yep, totally. You look here at their earnings, the expectations varied quite a bit. This goes back to Q1 of 2022, where earnings were declining fairly rapidly. And now all of a sudden, we had this kind of bottom out down here, right around 30 cents of actual income for that quarter. The next quarter jumps up to 99. So tripled their earnings in that quarter for Q4 of 2022. And now the expectations about their May 9th earnings announcement are higher than the previous quarter's earnings as well. So it looks like they're doing rather well. If I look at Disney, I think you'd all agree that Disneyland, Disney World, these Disney parks, probably not going to be going under anytime soon. Those are just legacy establishments. The question I would have is, and I don't know the answer to this, I'm sure some of you may know more than I do, is if you look at all of the different media outlets and channels that Disney has, which ones might be struggling, which ones might be succeeding, how are they going to continue with Disney Plus? Is the increased competition from Paramount, from Hulu, from Roku, from Netflix, is that taking part of their market share and maybe hurting Disney? That might be an issue, but I haven't looked at that, and I'm not smart enough to look through the financials to figure all that stuff out. Maybe I'll bring Colin Teddards of the Investor Channel on to answer those questions. But to look at the question that came in from Irfan initially, thoughts on Disney, heard they were doing massive layoffs. Yes, to me, that's a buy the rumor, sell the news kind of thing. If I look at the chart of Disney, which is where I'm going to make my decision off of, I'm going to go, let's start with the weekly, which I normally don't like to do, but let's look at the big picture. So you can see that Disney has been on a pretty nice uptrend, except for this, market crash, if you will, starting in 2022. Well, why did that really sell off? Well, you had obviously the parks were slowing down, parks were closed for a while, but I think that maybe drew people to more of Disney's media projects like Disney Plus. So it's kind of right back down to those COVID lows, right as COVID hit, right? Those are your COVID lows there back in March of 2020. We're almost back to those levels. And I would argue that if you look at the long-term trend here, you were probably back down. Long-term trend here, I would say you're probably looking at like $70 for Walt Disney. But, I'm sorry. Thank you, guys. Thanks, Big Eb. Oh, boy. Anyway, I'll start all over again. So if you look at the that sell-off that happened here, same for not moving my chart over. It should pop over in just a couple of seconds for you guys. We've given back a lot on Disney. So I'm looking at Disney right now as maybe even potential attractive buy. If you look at that sell-off here, there's your chart. 55% slide from its all-time high. I'm not a long-term holder of Disney. I've never owned long-term. I've traded it a couple times, but I generally like to trade NASDAQ stocks, not NYSE for some other reasons. If you're a value investor, somebody that's looking long-term, then I actually think for Irfan here, and I don't know if he's an OTA instructor, just the name was just Irfan, but there is an Irfan that works for OTA. Maybe it is that Irfan, I don't know. I know it's not the most rare name out there. You're looking at this picture, you kind of got to say, am I going to take that chance? If we start seeing economic slowdown here, does Disney do more layoffs? Do they start to slow down a little bit on their media properties as well? I don't know. It looks to me like a 50% decline, 50+% decline in Disney over the past 2 years is a pretty substantial decline for a company that is well established in a lot of different media fronts. So I guess it begs the question, do you buy it at this point? Irfan, and maybe that's what you're asking me. If I looked at this, I would probably be okay trying to maybe sell the $80 puts right now, just because that's the lowest point we've seen here. You can see it bounce back off that 80 mark back in October of 2014. Gotta love something that's 9 years old. And you also have this little level right here, which goes back into March 16th of 2020. So we're pretty much coming back down to those levels. I would be okay with that. I think what you're going to see is actually Disney chop sideways for a little bit. I don't expect there to be any real major moves up. If you look at the daily, though, there's your daily. You know, you've been showing lower highs and lower lows going all the way back to that peak in 2021. So it does not look great. You know, the only saving grace here is the low we established just a couple weeks ago on March 10th. Was not a new low, but at this point, I just kind of expect Disney to traverse sideways here and just chop. That's where I'm going. So, Irfan, that's my thought on Disney. I still think it's the happiest place on earth, unless you go there with toddlers or young children. Then it's just an absolute nightmare on earth. But yeah, I enjoy going to Disney. I like Disney. I went to Disney World a couple years ago. That was fun. I really liked Epcot Center. That whole area was really, really cool, and just the different cultures and education and science. Disney, awesome stuff. Especially for a guy that people said will never make it, lacks creativity. Really? Pretty sure Walt Disney had some pretty good degrees of creativity. So that's my thoughts on it, Irfan. I'm sure other people here might be bullish, might be bearish, but I'm not trying to paint a picture one way or the other. Personally, I would be on the slightly bullish side, although, I do think it's going to traverse sideways here. I think that the news came out today was all just after the fact, right? You knew about these layoffs going back into February of this year, so it's 2 months old news. Maybe we'll blast when our daughters... Oh, you had a blast? Good. You know, it's funny. I always go there. Well, I don't always go there. But the times I go there, you have some kids who are just enamored and love it, and this is the greatest thing ever. And maybe that's because it's early in the day. But then you also get some kids who are just screaming and kicking and yelling and creating an absolute nightmare for everybody around them. And maybe that's near the end of the day. But I guess just attention spans of children here. I don't know. Says the guy who was a German Shepherd. That's my child. And he doesn't really throw temper tantrums, does he? Okay, that's all I got for you on Disney. That's it. It would seem to be a topic for the day, and I thought, why not just go and bring that one on there and show an image that might get me in trouble with copyright officials. Thanks everybody for bringing that to my attention. I'll see if I get some handcuffs or some shackles on me for my Mickey imposter over here. And see, it doesn't even look like him. I got 3 buttons. Yes, the spoiled brats, Liz. You know it. All right, no. We're not going to do short session. Well, I mean, I'll probably run a half hour, but we will keep going them. All right, let's keep going. I want to go through the top 7 here. We obviously had Bitcoin selling off quite a bit today. This was not good. Well, I mean, it wasn't the end of the world, but down 3.35% right now, making it your worst performer, just under $27,000. And again, in the CIL, I've been telling them, look, I really just feel like Bitcoin's going to have this pullback here because of all the negativity, all the regulation. There's even more lawsuits coming out from the SEC over different entities. So it's just really getting rough and rougher in that crypto world. So it just kind of felt like Bitcoin would be selling off, but didn't. Just 3.3% today, not that big of a deal. Is that a small world after all on top? On the logo? I don't know. Is it? I don't see any small world in there. Gold. All right, so as you guys know, my silver was taken away from me on Friday. My options expired in the money, so whoever I sold those to took the silver away at $21 per share, my GLD at 21 per share. And so I actually sold some today. The premium was pretty good, and I'm actually bullish long-term on silver. Let me bring that up. I know I have gold up here, but I thought I would just parlay that into an SLV conversation. Oh, so I actually sold... It's pretty aggressive. I actually sold the 21 SLVs today, expiring this Friday, and ended up getting 21 cents. So basically a 1% rate of return for 7 days on silver, which I'm totally happy owning silver again at 21. You know, if it continues this most recent sell-off and gets back down to 2050, you know, I'm fine. I'd be happy to own silver again. Again, my shares were taken away because I sold sold covered calls on it, and those shares disappeared at $21. So I added that today. I'm kind of reloading my position on silver here, and if it drops down below 21, I will be a holder of silver yet again on Friday. So gold, 1.5% slide today. Really nothing to be paranoid about. We're still making higher lows. As you can see, this traverse go up here for the gold futures product. So even though it's a big down day, I still like gold long term. You know, we talked about that 2,000 mark. I guess the bigger question is what happens next if we get above that. So we zoom out here, and I'm going all the way back. Let's do the longest term I can get here for this gold futures chart. I'll go monthly. Obviously, you can see it goes back in the 1975. Oh, it's just a wee little lad up there. A wee lad. Don't remember gold at that moment in time. But anyway, all-time highs here that you're looking at for gold futures go back to August of 2020 when gold hit a high of 2,089. And I guess the question is, do we get there? You look at this price chart here. Here's your weekly. You had this come up in overhead supply, sell off. The question I have now is, how far will this pullback take us down on gold? And if it breaks these lows below 1,800, yeah, then we've got some bigger problems. But if it stays up there above, and let's say it doesn't break below 1,900, then I think we'll probably rally and charge and head towards those all-time highs yet again on gold. And I think the uncertainty about our economy and the banking system will have a factor in that, pushing it up towards these all-time highs yet again. So I'm all right with that. Aren't banks stepping in to take over crypto exchanges? Good for Bitcoin long term. Well, they're not really taking over exchanges. The FTC or the SEC is going after more people. As Dr. Bondi says, Binance is sued. So they've gone after Kraken for staking, which is unregistered securities. They just did a Wells notice to Coinbase, which says, hey, we're going to sue you for selling unregistered securities. And now they're going after Binance and saying, hey, we have 4 different suits against you for selling unregistered securities. Kraken seems to be, Gemini seems to be the only one who's staying clean in this argument, or lawsuit soiree, if you will. My guess is they'll probably get a lawsuit here soon because they were also doing lending, which in the eyes of the SEC is unregistered securities. I don't know if there's any yearly charts on TradeStation, Pepe. I haven't used TradeStation forever. Is there yearly charts on... there you go. So you do have yearly charts on TradingView. That's a little bit long-term for me personally. Again, my favorite chart is the daily. So that's your gold. We'll go to the NASDAQ, which was kind of a mess today. It just kind of kept bouncing around and then started to show some weakness near the end there. We'll bring up that 15. Right, you had all this kind of volatility over the past few days, and let's 15-minute time frame. When we opened up, it had a little bit of chop, sold off, started to rally back up again, and then just ended up closing near session lows. So not the best day for the NASDAQ, which on the day was down 0.79. Bring up my QQQs here. Hold on. Yep, there you go. 0.69 on the triple Qs, which came right back into that 308 level that it bounced off of for about a week back in late March. So back to my daily here, working our way up the ladder. Technically, you're still flirting with those highs on this NASDAQ 100, so ultimately time will tell. The longer it stays here, the more likely it will break through that upside. So keep your eye on the consolidation that happens here on those triple Qs. Next on our list is going all the way up to the S&P 500, which is 4th place. Still looking at this kind of sideways consolidation, this pinching, if you will, this triangle. Some call it a pennant, some call it a symmetrical triangle. And there's always this talk track about how you read these things, and some technical analysis books will say when it gets 2/3 of the way through the triangle, that's when it breaks up. I don't know if I buy that at all, but it looks to me like it's roughly 2/3 of the way through, maybe another few days in this triangle here as it compresses. Just to make this work, though, we don't want to make new highs, don't want to make new lows, just kind of keep traversing and then get ready for that breakout, because when the breakout comes, it'll be strong, it'll be fast, it'll be aggressive. All right, moving up, Dow finally back to podium. We got bronze medal for the Dow, which is positive on the day, 0.61%, but technically nothing here, just chop. We've had a lot of volatility, a lot of long bottoming tails on this one, which means that there's buying support coming in for the for the Dow components. But ultimately, this candle today, even though it was green, is up 0.61%. There isn't anything really clear here that says, oh, wow, this was a great trade one way or the other, or here's where it's going. All right, your Russell, which we had that hammer formation form on Friday, which I liked much better than the Dow. Main reason being, it was near the bottom of the range for the Russell, and you can see we followed through with that one today. So if you're playing the TraderMerlin strategy, I guess, the way I use candlesticks formations, you had a nice winning trade on today for that Russell based off a break of Friday's high. And finally, crude oil finally getting back a nice big green candle, 5.13% move up for crude oil today. So that demand zone from this yellow box, which became supply, get rid of it. I'm actually going to take that yellow box off altogether because I think we are going to have to reestablish ourselves with some new trend. We've broke down below demand, ripped back above it when it was supposed to be supply, and there you go. Let's see. That was it. There was a couple other things. Now, the dollar index, we had that nice little pop for 2 days back on Thursday and Friday as it moved back to the upside off this hammer formation, but giving it back. So, the follow through on the hammer, you would expect it to be bigger and more powerful. So now it leads me to believe you'll see more downside move for that NASDAQ or for the dollar index here. Again, the further down the dollar index goes, the higher the equity markets will go. So keep your eye on that one. And last piece, Now, I didn't bring this one up on Friday, but when I look at things like the 30-year versus the 2, we actually tipped back to a flat yield curve on Friday, which most people don't look at the 30 and the 2, but it's the 10 and the 2 that they're checking out, which is this one right here. We got relatively close, and we were almost at 1.1% inversion on that yield curve between the 10 and the 2. Right now, you're looking at 0.46, so it's gotten a lot better, but still a ways to go to get back up to that flat part. If we get to this green line up at the top here where my cursor is bumping around, that's where the 10 and the 2-year will offer the same amount of yield. And by the way, Big Eb, you were kind of scratching your head going, God, why is Schwab getting hit so hard? I guess in some analysis of their portfolio, a lot of their assets were sitting in long-term dated maturities, which is the same thing that got Silvergate into trouble. The big difference here is Silvergate had 90% of their customers were exceeding the FDIC limits of protection, whereas Charles Schwab has 20% of their clients exceed it. So no real worries there about people running and trying to get all their money out because they're all protected. So I still think that Schwab is in a much safer place. It's a question of how much damage those long-term maturities will do. Then again, if we see this continue, and this inversion starts to get back to normal, right? This is measuring the degree of inversion here. If we start to get above this green line, then all those bonds that Schwab holds will do fine. The problem right now is that there's an inversion, so they'll buy short, sell long, and But the bottom line is that inversion is killing them. If it gets back to normal and they'll hold to maturity and not forced to sell, then they'll be okay. So I think Schwab will probably do all right going forward. I think Lisa answered Ganesh's question. How you do covered calls if your current price is way less than your average cost? Say your average is 100 and the stock is now 75. You sell 80 calls, the price goes above 80, you'll be a loss. Yeah, I mean, you could still sell the hundreds if you wanted to. You're just not going to get as much premium on them, right? So it's about, as Lisa says, you could roll those calls, but what I would be doing is I'd say, where do I think it's going to go in the next week or month, and start selling calls. And I might not sell those hundreds. I might actually sell the 90s or somewhere I don't think it's going to get. And let's say I collect $10 worth of premium by selling, the 90s. Okay, well, then I'll sell the 90s when my average price was 100. Now I collect $10 of the premium. My average price is 90. So I'm using that to offset my cost average. Yeah. Oh, Big Eb, you sold? Big Eb sold, guys. So basically, you should just load the boat on Charles Schwab. It's going to go to the moon. All right. I'm kidding, by the way. Don't ever load the boat on anything. So let me go through a couple of lists of questions. Scott says, and this was sent through email. Again, you guys have multiple ways you can contact me. As you know, the preferred method would be just to post any question below a YouTube video. It's supposed to help in search engine optimization, I believe. Plus, I can just cut those out and put them into the slide deck here, or you can email me at TraderMerlin@gmail.com. So Scott says, I bought 100 shares of First Citizens Bank last week. Great news today. What do you think now, or what would you do now if you own the stock? This one's really easy. So let's see. First, this is I don't use it. I think it's FCNCA? No, FCNCA. Yeah, First Citizens Bank shares. So if you bought this one last week, I'm not exactly sure where you bought it. I operate off the belief that you never look a gift horse in the mouth. So, Scott, you were taking some chances catching falling knives, right? You were trying to buy some things as they were really beaten down. If you look at this First Bank shares, obviously looking at a price chart of $836, fell all the way down to just almost 500. That's a significant decline, in the value of First Citizens Bank shares. Of course, a lot of this is them getting wrapped up in the whole banking fiasco. Well, today, because of the news, they actually bought Silicon Valley Bank. Citizens has actually bought a lot of FDI bank sales assets over the years and acquired several banks this way. But now, there's 17 branches of Silicon Valley Bank, which will now open up maybe tomorrow under the title of First Citizens Bank shares. So, all in all, this is great. Do I think it's going to continue to rock and just keep on going? No. If this was me, Scott, it's real simple what I would do. I would just log into my platform. I'd hit that sell button because I know my shares gained in value 53% in one day, and that's after Friday's close. I'm not sure where you bought it. Judging by what you mentioned last week, that could be anywhere between, let's see, the low price of last week is $525. The high price was $580. So no matter what, you're at least in $300 worth of profit. No matter, even if you bought the highest price last week, you still have $300 per share. You have 100 shares right now. So, that's what, 30 grand? You should be really happy with that. I would absolutely take the money and run, as Lisa says, no problem. I would hightail it. You absolutely have a gift horse here. I'm kind of worried that you're holding it over. I wish I could have done the show earlier so I could have said, get out, Scott. But again, that's me. Could First Citizens Bank rally even more tomorrow? Let's look at the weekly chart here just to get a perspective of where it came from. It really feels like it's kind of plateaued here and it hasn't done much. And you're right up to almost all-time highs. All-time highs goes back to the week of January 3rd of 2022 when it hit a high price of $947. So you're $50 off the all-time high. I'd say don't get greedy. Man, you make 53% in a day. You should just be overjoyed. As you guys know, I have several bank positions right now, and I almost wanted to sell one of them, which was the First Republic. So you guys know I sold the First Republic puts last week. I think I can remember who it was. I think Jeff may be the one who did that trade as well, and it's kind of coincidental we both had the same trade. So when you have something like that, when it jumps up 50%, sell it, especially in the crisis situation that banks are in. This could still continue to drift down here. It's just good news on the day that it's going to bail out Silicon Valley Bank. But there's a lot of good stuff out there. JP Morgan was up today. Now, I am still underwater on JP Morgan. 32 is my average price that I paid. But I also collected a lot of money with puts, and I don't know my exact price, but I think my average price for those puts is, I don't have to do the math. I have a spreadsheet here somewhere with it all. Now, if you look at that one, should I have sold today because it was up 2.87%? No, I'm going to keep that because my options expire this Friday, and I've been selling weekly or 2 weeks out, which I will continue to do against my $32 position. I think that ultimately JP Morgan will be fine. I believe that a lot of the deposits that are leaving these small and regional banks are going to go into the big ones, which again is why I bought JP Morgan and why I bought Bank of America, which was up 4.97% today. A nice day for JP Morgan. So we'll see if I can get that one back up. And this one actually might be my big winner out there. There you go. Fine bottle. I just buy me a drink next time we see each other. My liquor cabinet is pretty damn full right now, I must admit. It's pretty cluttered with some I have to start drinking more apparently. Banks are severely limited credit right now. Recession is a sure thing. It's a good question. Because of this issue with the banks, that this is the big dilemma and big conversation topic is, what will the tightening of credit conditions do to our markets? When you have banks unwilling to lend out, markets suffer. And that's probably what's going to happen, right? You're going to see, especially the regionals, tighten up their lending practices. You're going to see all banks tighten up their lending practices because what I think is going to happen and what should happen is the Federal Reserve is probably, if they don't, they're just idiots. They should be raising the reserve requirements. Keeping the reserve requirements at zero since COVID hit is a large part of why we have this problem right now. So as long as you have a reserve requirement, let's say 10%, that means that you can put a big damper on runs on your bank. Now, it might be too little too late at this point to do that, but because I think that the FDIC or the Fed is going to raise the reserve requirements, banks are now going to be a little bit more constrictive with their credit because they need to start building up some of those assets of customer deposits. Now, they'll probably go 5%, and then another 8 months they'll do another 5% and get it back to 10, which is kind of that long-term historical average there for reserve requirements. But yeah, tightening the lending credit conditions could really be an issue that does push into recession. Again, I don't know, Big Eb, if that's the main catalyst, but it certainly is not going to help when you have banks unwilling to lend where they normally would, and they're being restrictive on credit. That could be a big problem. I don't know if they're going to start calling in loans. That would be crazy now. That would really be bad. That'd be really, really bad. Most of the bank problems is due to banks holding long-dated maturities. Yep, if the Fed allows these maturities to mature now instead of 30 years, all banks will be saved without. Yeah, but I don't think the Fed's going to just say, okay, well, forgive the 30-year, we'll just erase it. That would be a colossal mistake in my mind. Bailing out the banks is one thing, but now saying, hey, we'll just pay off all those bonds now to erase that and alleviate any problems that might be there, I don't know. I think that's a bit too risky. And plus, you'd be putting a massive amount of cash back into the system, and all of a sudden now you're back to a hyperinflationary environment. So it is a solution, but I think that that's just a latch stitch, everyone. Blue Diesel Merlin, when there is technically outward declaration of recession, how will markets and crypto react? We know things are bad, but how bad do you think it can get? I'll be honest, I don't think that this is going to be like an apocalyptic type of recession. I think it's going to get back to normal. A lot of people just don't understand the impacts of all of the loosening that we did with money policy. And COVID really just pushed that into high gear, where all of a sudden we were flooding the markets with money. I mean, drowning in it. So you have to remove that money supply at a certain point just to get things back to normal. So I think that the recession will not really be like a bad recession. I think it's going to be a reset that gets us back to a normal level of where we should be at from market growth perspective, from employment perspective, from GDP perspective. So I don't think it's going to be a massive sell-off crash. Oh no, the sky is falling. Let me just bring up a chart here, and I'll bring it up on a monthly. You know, you look at these falls that happened in the S&P back in 2000, right? That was a big drop. That was 50%. Same with this guy here. I think it's 57%. You know, do we get a drop down? I do think we'll continue to drift lower. You know, the S&P is still so far away from the lows we saw during COVID. I mean, this rally is just absolutely insane. This is not normal. This pump right here, let me put a line on it, just a yellow box, because I know Tom's watching. He just loves the yellow box. But I'm going to misuse the yellow box. Tom's going to be all upset with me today. There we go. I'm just using it to highlight the range here of this one. That is not a spread trade by any means. But you look at that move, that's an outlier. I mean, I'll even set it to logarithmic just so Tom really gets excited. There's your logarithmic scale of that one. Then that's unlike any move you see on this chart. Now, there are some steep ones, right? There's some nice moves up here out of the 2009 lows when they were just pumping money into the market again. But I just think that this is, you know, very, very steep. It was fueled by fake money being poured in the markets. That money now has to get pulled out. So, you know, where do we pull back to? You know, even as I mentioned, the 50% off the all-time high, which would be not that bad of a thing. It would be a normal market pullback compared to what we've seen back in 2000 and 2007. You know, that gets us down to here. Now, does that have to happen in a month? No. Could we just drift down there over the next year or so? Sure. You know, there's a lot of unknowns, a lot of uncertainty. And I don't think you're going to have the panic market, you know, colossal sell-off just cratering left and right. But I do think we'll just continually drift lower and lower. Now, that might speed up if we get kind of these black swans that I talked about in my article, which are, you know, banking fiascos or systemic failures because the government or the Fed or the FDIC or Treasury have screwed up somehow. Yellow triangle, yellow rhombus. You're funny, Tom. Let's see. Let me read through the questions here. Sell and send. I always like whiskey. Merlin needs to have a cocktail hour with the group. Well, for those, yeah. Unfortunately, you know, I'm trying to do a cocktail hour. That'd be great, but you know, only a few people live here in Southern California. We can patch everyone else in live. So, Scott, that's the news there. I would say sell it. Don't. And if it rallies up tomorrow after you sold it, so what? Who cares, dude? You made $30,000. That's awesome. You made 30 grand on that, man. Just put that in perspective. You bought 100 shares and you made 30 grand. So yeah, enjoy, my friend. Move on and just let it be. You know, for me, it'll all come down to this Friday is the determining factor whether I am out of my First Republic put position, which is a super risky one. The JP Morgan or Bank of America, we'll see. All right. Oh, now that I hear it, just so you guys know, I may have to cancel some shows here in the near future. So my neighbors have a 1,300 square foot home. And I got a notice from the city that they're turning their 1,300 square foot home into a 3,800 square foot home. And the jackhammer started at about 9 o'clock this morning. I anticipate them destroying this house for the next year. And it literally is right outside this window in my upstairs studio. So unless I move my studio to some other part of the building, which I don't have space, you're going to hear a lot of construction and weird noises in the background. So I'll do these shows for a while. We'll see how, hopefully it won't be too damaging, but there's going to be major destruction going on outside the windows. I apologize, but nothing I can do about it. While I'm on the option side of things, Betty says, when you sell options for credit, why not sell on Friday for next week so you have the premium reduced over the weekend? What is the advantage of selling on Fridays versus Monday? Well, if I could, Betty, I'd absolutely look to sell on a Friday. Absolutely. You get 2 free days of free decay on those options. Yeah, Friday's a way better day. Well, let's say I've got a $10,000 account, right? And pick any day of the week. Let's say I sold on Friday, expiring next Friday. Okay, so let's say I sold them last Friday and they expire this Friday the 31st. When that option expires on Friday, I don't get that capital till Monday morning, which is why I'm selling on Monday typically. If there's no opportunity, I won't, but typically I'll sell on Monday because now that capital is freed up. I prefer to let my options expire worthless. Now, what I could do is I could sell or close out my position, right? So let's say I sold puts. You use the example of First Republic, since I sold the $10 puts last Friday, expiring this Friday. Let's say we get to Friday and they're so out of the money, I could just close those right now and resell those again and get more premium. Or I could not pay the commissions on that and just let them expire worthless, get the money on Monday. So that's what I do, is I'll just let them expire worthless, get the money on Monday and do it. You could spend some money for commissions, close out that trade, and then resell those options on Friday for the next Friday. But that's just a matter of personal preference. I like to let them expire worthless. It makes me feel good because I'm like, I sold somebody a losing position of nothing. That's why. All right. There you go. So, sorry, I'm just reading through some comments here. How do you get away with that name? Which name? Where are we talking about? What did I miss here? What did I miss? Well, you see the article about visual capitalist, about de-dollarization. That would be, you know what? It's funny you say that because I was thinking about doing one, like what would be the impacts of moving away from the dollar? And of course, Elon Musk has said that World War III will be fought over AI, which he may well be right. However, I've always thought that World War III would be fought over the dollar, meaning that countries would be moving away from the dollar as a reserve currency, thus damaging our power and our stranglehold on the global economy. Once we lose that, it could get real ugly for us. So, yeah, maybe I'll do a show on that one in the future. All right, let me get to a couple other questions here, make sure I got them all. All right, so there's one in here came from Skilled Stocksman. He says, on gold. Let's go to gold futures here. There's the GC. Greg, while shortest time frame is 30 minutes, Bob's is a daily. What is your opinion on each time frame? I'm long 3 micros, but with a bigger risk than usual on gold futures. So, Craig, he says this. Craig Weil, love Craig Weil. I like to start on the bigger time frames. Now, Bob likes the weekly. I don't really care. The picture tells me the same thing, right? If I look at this, it almost looks like I've got a gigantic cup and handle, a massive cup and handle formation, almost. But more importantly, it's telling me that gold has been hitting its head around this $2,000 mark, right? You can see, let me get rid of some of these lines here. You guys can see that blue dashed line at the top, or near the top. It keeps hitting that one. Well, that's the weekly. If I go here to the daily, I can zoom out of here and I see the same picture, but I get more of a sense as to what happened on the intraday movement. So I prefer the daily to start, but remember, Bob doesn't trade off anything smaller than a daily. Like if I've looked at this price chart here and I said, okay, we've come into supply. Let's say that $2,000 is that supply level for gold. I'll zoom out here and I'm probably going to be looking to be going short. Now, of course, I would have done it as it came into 2,000 on this candle here back on March 20th. Now it's a little bit late, and then once I figured that I'm looking to go short, I might break this down into the hourly, right? And see where might be a level where I want to get in short here. So I look at all different time frames, Skilled Stocksman. I start on the daily. And on my trading system, I have 10 charts. I have the daily, and the top row is all the market or the index that I'm using as my guide. So the top set of charts is all market or index. The bottom is individual securities. So I might have, let's say I'm looking at Microsoft, right? Trading Microsoft. On the top, I'm probably going to have the NASDAQ 100. So I go daily of the NASDAQ, daily of NASDAQ 100, daily of Microsoft, right underneath that for correlation, so they line up. So the chart right next to that, the hourly. So I'm looking at the hourly time frame of Microsoft and then and the triple Qs. On the far right chart, I've got the 15 and the 15 and the 5 and the 5, and then on my mission control where I have all my order execution, my watch list, my filters, I have a 1 minute of the index and 1 minute of Microsoft, but that's really shrunk down. I generally don't trade off the 1 minute anymore. It's just old habits die hard, so I keep that 1 minute. So I guess that I would say, Skilled Stockman, that's kind of my perspective on that one. I like to look at all the different time frames, and it depends on what my objective is. Bob Dunn is a ride the wave kind of guy. That's his mantra, was ride the wave, right? Well, he's looking for the bigger moves, and that's the turtle traders type of thing, saying he wants the bigger move. I like the intermediate time frames. I like the trades that last a couple days to a couple weeks. I'm not really interested in holding things for 6 months or a year or a decade. That does not excite me whatsoever. But again, there's nothing wrong with those styles of trading. They all come with a specific set of risk, a specific set of rewards, and you have to analyze it and say, what am I comfortable with? How do I want to look at this market? U.S. Steel, huh? All right, let's go look at U.S. Steel. X. Okay, so here's your 1 hour. I don't want to start there. I start on the daily. So you look at the daily of U.S. Steel, and it actually is not that great looking of a chart, right? You've really been sideways since 2020. Your low is down here right around, let's call it $16. Your high is 38. So while it's a big range, it just seems to be doing a lot of chop. So if I zoom into what's going on recently, I could make the argument that really from these lows that we saw back in June of 2022, it looks good, right? It looks like you're making higher highs, higher lows, slowly building up. What I don't like is this area right here. I don't like that we came right back down to those lows that we saw back in December of last year, and now you're just kind of sitting there. This is a pullback for sure. It's a question of, is this pullback going to hold, or is there something fundamentally wrong with U.S. Steel that could cause this to all of a sudden break down below these lows of $23.50 and all of a sudden close this gap and end up at $22 or maybe even lower? So I would wait for a breakout of that yellow box and before I made a decision. Since I have no position in U.S. Steel, my bias, if you put a gun to my head and said, well, actually this is the wrong society to say put a gun to my head. If you forced me to say, hey, I got to make a trade here, my bias would be bullish. My bias would be the long side. But again, I'd much rather leave some money on the table, and I would click this little yellow box right here. Come on. And you can see that that box ranges from about 23.76 to 26.25. So for me, I'd say if it gets above 26.25, okay, I'll go long. But I would be leaving some money on the table, and I am totally comfortable leaving some money on the table just to have the confirmation that that is now broken out and moving to the upside. Some of you might be more aggressive and jumping earlier. The market says here 24.85. So you're looking, let me put a line right at 24.85. So we're looking at the exact line there. And I will even put it in here as a 24.85, right? Is that what you said? 24.85? Yep. So she's got it right there, 24.85. That's that low of today, right? Your low price today was 24.85. Sure. But I wouldn't necessarily call that a demand zone, right? You're kind of in the middle of that space. Could you buy there? Absolutely. If you're buying there, though, got to put your stop loss down below these lows and make sure you stick to it. So again, because of my uncertainty and uncomfortableness with how far this one pulled back, I would wait for a breakout. If it was let's say, for example, and this is like just course talk here, let's say the picture looked like this. All right, now I'd be okay buying at that moment in time, because you're coming into this kind of one-day rally out. You got a little bit of hesitation candle, fine. But now because it went so low, it makes me feel like there's a bit more weakness here with U.S. Steel, just the way I'm looking at it. Puts were doing great until they weren't. Yeah, it's funny how that is, right? Everything works until it doesn't. I had 26K puts on X. Friday was proud owner of many shares. Okay. Well, it's only 1,200 shares. No, it's not the end of the world. And you sold at 26. Okay. And I wonder why 26. If you look, because this area right here is the area that I would be looking at selling those puts at, buying because of this kind of basing and then the rip out. So that would have put me right around 25. Maybe it was just a premium thing, but I don't think you're in a bad spot. It's just be really careful, because if you do break below these lows, then all of a sudden this trend, this slight uptrend that we've had since September of last year, which I would say is probably where you're hanging your hat on that trend, that means that trend is now done. So just be careful if we get below that, but I think you'll be okay here. I think we'll probably move to the upside. And the big issue, like Big Ed pointed out earlier, is what's the credit going to look like for banks? How are they going to be lending out money going forward? And if they continue to tighten and tighten and tighten, then this could put pressure on things like U.S. Steel. Because remember, if there's a credit crunch, that means expansion is going to start to slow down. There will be no new buildings being built. There'll be no new project, not none, but there'll be a contraction in new buildings being built. New infrastructure projects are going to start to slow down because people are reining in cash. So if that credit crunch really does start to impact, U.S. Steel might be stuck with a bunch of steel they can't sell because we've seen development slow down. So just something to think about, that domino effect of this potential credit crunch. So be careful out there with that one. Now, right now, the chart looks okay. Again, if I have to put here's the scale of 100% being I guarantee it's going up and 0 means I guarantee it's going down, I would probably put myself at like a 55. I mean, there's a slight bias I have towards the bullish side of this one. Slight. Price went up when I sold them. I'm looking for a pop to sell calls at 26 or 27. We'll make okay money on the trade like that if taken anyway. Yep. XLF. All right, last one. I got to wrap up. I was going to try to shoot for half hour today. Didn't work. Dave says, can you look at XLF and looking to buy puts around 69? I believe my chart is closed. On XLF? No, Lisa. One thing to know about me, like, even if I was... I'm certainly not going to try to make you feel worse, but I'm just going to call it how I see it, right? Lisa, if I looked at that chart and I thought it doesn't look good, it's probably going down, what do you think I'm going to tell you? I would rather you hear a truth from me, whether it's a slight pain point or it hurt real bad, just to kind of wake you up. Merlin Mondo's awake. So yeah, I'm not trying to say that to buddy up. I generally feel like there's a slight bias to bullish prices. Yeah, I think you did mean 29, not 69. So anyway, here is your XLF. 69, I'm sure that's not going to happen, but I'm pretty sure it's 39. Let's see. Dave says, could you look at XLF? I am looking to buy puts around $69. I believe my chart is closed. I think you mean 29 here. Okay, my fault. 32.50 was my price. There you go. So if you're looking to buy puts at 32.50, you're already in the money, so you're going to be paying a pretty good amount of money for that. And by the way, all the puts right now in XLF are going to be very, very, very expensive, right? Because there's a lot more fear in the industry about financials going down. I have been selling puts. I have been selling puts myself. I sold the 29s as well. I sold those last week. So, that's basically below these lows. And you can actually see... I'll put a line here, which I don't know what color it's going to be. Dotted red line right at 29. Those are the puts I sold. The premium was actually pretty good because the pain is still there. People are looking to buy puts. So if you're selling the 29s, I would say you're probably going to do okay. I guess it depends on what time frame. I actually, mine were, I think, in this account, the XLF are for April 21st. So I'm giving it a bit of a little too long of a leash, I think. You really don't want to be in the financials juggling with this kind of volatility, but the premium is really good. So I have the 29 puts on XLF going out to April 21st. Most of my other stuff is expiring this Friday for the bank stocks, but I think that may have helped you. No whiskey today, Advut. No, not on a Monday, man. This week is a very busy week for me, so I just like to drink on Fridays, and I'll actually have a beer or two on Thursdays when I do trivia. All right, so that's it. Dave, I think you're probably, my plan was to buy the 32.50 a few weeks out, and then price gets to 31.80. Well, you could do that, but if you buy in the money at 32.50, then you're going to be required to buy it at 30. You'll be long at 32.50. Obviously, you're collecting a lot of premium on this one, right? So let me put the line at 32.50 here. So if you're going to sell that 32.50 put, you're already in the money by over $1. So you're going to collect a lot of premium, right? So what you're hoping is if you hold on, let me see, buy or sell these puts. Sorry, maybe it's reading wrong. Where'd that comment from Dave go? There it is. And things are moving. I'm looking to buy puts. Okay, I'm sorry, I read it wrong. So if you're looking to buy these puts, obviously you're going to pay a premium. But why would you buy it in the money? Why not? If you're going to buy them, and you think it's going to go as low as you say it's going to go, like you think it's going to go to 31.81, right? Then if you think it's going to get to 31.81 from now, that's a higher price than current level. So why are you buying a put? Right? If you think it's going to bounce, you don't want to be buying a put. And then you want to be selling the puts, right? Collect the premium. But if you send in your message you're going to be buying the puts on this one, well, I don't see the point of buying the 32.50s if you think it's just going to bounce back up to 31.80. You're probably, those puts will gain a little bit of value, but they're also going to expire. I mean, it really depends on how far out you go with those puts. You're suffering from time decay on this bad boy. I personally wouldn't do it. If I was going to buy puts and think it was going to go down, yeah, sure. But I don't play that way where I buy them in the money and then hope to gain more value on it. I like to go for the illiquid ones, and hopefully when they're in the money, I get more liquidity and the premium gets better for me. All right, I got to wrap up. I went to go long. Kenneth says, what's the best exchange to do recurring buys of Bitcoin? I've noticed that when doing recurring buys on Binance.us, the buy price of Bitcoin is 6-7. Yeah, so that's the same everywhere. If you do recurring buys over at Coinbase, it's $1,000 more, depending on the day. So they always inflate the spread on these exchanges. That's typical for a market buy. So you're now going to be, you're a taker of liquidity, not a maker, and that fees are going to be higher there. So I would say the best place to do recurring buys is on Binance.us, and the main reason for that is there's no fee for transaction fees. If you do recurring buys on Coinbase, not only do they charge you a wider spread, but they also add in a base fee, which is anywhere between 1.5% to 3%. It's just why spend that extra kind of money? So I would say personally, Binance.us would be the place to go. All right, let me wrap this up here so I can get out of here. For tomorrow, here's what we got cooking from an earnings perspective. You got a whole fun place to go, Dave and Buster's, like that. You've also got the top there, Micron Technologies, Lululemon, home of the transparent athletic wear. Gotta love that one. And Walgreens, Boots Alliance, and McCormick and Company. So that's pretty much it as far as earnings for tomorrow. And this one always fascinates me. When I lived in Italy, a lot of the soccer teams actually had publicly traded shares. And so talk about manipulation, right? If you know that Manchester's going to win, well, you buy Manchester United stock. If you know they're going to lose, you short Manchester United stock. And boy, it just opens up the door for so much insider trading, if you will. Anyway. Here's what's the economic calendar for tomorrow. You can see actually a lot of stuff happening for the U.S., and this one's pretty important. In the middle of the page there, 6 a.m. Pacific time, which is 30 minutes before the markets open, you can see U.S. HPI numbers. You also have the Case-Shiller Composite S&P Composite 20 Home Price Index. That's expected to drop from 4.6 to 2.6. Now, that's year over year. This is a huge problem. Let me bring this one up for you guys just so you can see the numbers because it's pretty ugly. Here is going all the way back into 2007, showing you the annual, this is the key, the annual rate of change for housing prices in the Case-Shiller S&P Composite 20 Home Price Index. But look what's happened over since May of 2022. We were over 20% year-over-year growth in housing prices. Now we're at 4.6. Remember, this is annualized. So the number that you see here is taking into consideration the last 12 months of rating, of change. Well, the last few months have been averaging negative 0.8% or 1%. I'll just round up, say 1% decline, which means that as we go forward another 5 or 6 months here, you're going to see on this Case-Shiller S&P Composite Home Price Index, something looks like this. It's going to go negative, right? So mark my words. If this chart is telling you anything, it's saying we had some really strong months, but now all of a sudden it's starting to sell off. And if it keeps decreasing like this, you're going to see this dip into negative territory, which we have not seen since 2012. So just letting you know, that's another shoe to drop that the media has not focused on yet, but we will see full contraction of home prices here going forward in just another couple of months. I mean, judging by the rate, it looks to me like, you get to August, July, August, you'll see this thing go negative. But anyway, that's that. Okay, I got to wrap things up. I got to get out of here. It's otherwise it's going to be a 1-hour show and Big Ab's going to gloat. Dave, we can try to tackle that question again for tomorrow. Just email it to me at TraderMerlin@gmail.com or go down below any YouTube video and just let me know what you guys want to discuss on the show. Yep, declining hard towards losses. It will be there very, very soon, Big Ab. And it's something, you look at the chart, that chart feels like, okay, well, we're still positive. No, we are not seeing year-over-year growth right now of 4.6%. Right? That means over the last year, yes, you've seen it, but right now the trend is aggressively down. And once that data annualizes and we take off the pieces that we're gaining back in here, this is going to just rip negative. So careful with that one. All right, that's going to do it for me. Tuesday, I have no guest for tomorrow. Wednesday, actually, let me see. I got a message from Jerry here during the show. Okay, so Jerry Baldwin's going to be on Wednesday. He'll be my guest for the show on Wednesday. We'll talk about futures trading again and look at different time frames, etc., and different maybe futures products. So if you guys have questions, let me know what you want to discuss. Again, today's show was driven by a good question from Irfan, which was thoughts on Disney. And while the picture looks very gloomy and sad, I think Disney's probably going to do okay in all of this. Maybe a slight slowdown, but I don't think that this is the end of the world. All right, that's going to do it for me. For anybody who might be new, hit that subscribe button. If you like the show, hit the like button. If you didn't like it, email me and tell me why you didn't like it. Don't be a coward. Just hit thumbs down and hate on me. You can tell me why you hate on me because it makes me better. That said, have a great day, everybody. I will see you all tomorrow. Take care.